If you have ever made money from stocks, crypto, or real estate and then felt confused or surprised by the taxes, you are not alone. Capital gains are one of the most misunderstood parts of the tax system. Two people can make the exact same profit and end up paying completely different amounts in tax. In this video, I am going to break capital gains and losses down step by step, using real examples, so you understand how they work, how they are taxed, and how to avoid common mistakes that can cost you thousands. This video is for anyone who owns assets outside of a regular paycheck. If you invest in stocks or ETFs, hold crypto, own a home, have rental property, or even run a business and invest extra cash on the side, capital gains apply to you. You do not need a finance background to follow along. I will explain everything in plain English and focus on what actually matters when tax time comes. Before we talk about capital gains, we need to clarify what the word capital actually means. In tax terms, capital usually refers to assets you own, not income you earn from working or running a business day to day. Capital assets are things you buy, hold, and eventually sell. Common examples include stocks, ETFs, crypto, real estate, and certain business assets. When you sell one of these assets, the IRS treats the profit or loss differently than wages or business income. Once you understand that difference, capital gains start to make a lot more sense. What is capital gain? A capital gain happens when you sell a capital asset for more than you paid for it. The amount you paid is called your cost basis. The gain is simply the sale price minus your cost basis. For example, if you buy a stock for $5,000 and later sell it for $8,000, you have a $3,000 capital gain. The same concept applies to real estate, crypto, or other assets. The asset type does not change the basic math, but it can change how the gain is taxed. A capital loss is the opposite. It happens when you sell an asset for less than what you paid for it. If you buy a stock for $10,000 and sell it for $7,000, you have a $3,000 capital loss. Many people see losses as purely negative, but from a tax perspective, losses can be very useful. Capital losses can reduce taxes on gains and, in some cases, reduce taxes on other income as well. One of the most important distinctions in capital gains is how long you held the asset before selling it. If you held the asset for 1 year or less, the gain or loss is considered short term. If you held it for more than 1 year, it is considered long term. That single timing difference can dramatically change how much tax you owe. This is one of the biggest areas where people accidentally overpay. Short term capital gains are taxed as ordinary income. That means they are taxed at the same rates as your salary or business income. If you are already in a higher tax bracket, short term gains can be very expensive. For example, if you sell a stock after only a few months and make a profit, that gain stacks on top of your other income and can even push you into a higher bracket. On the other hand, long-term capital gains are taxed at preferential federal rates, usually 0%, 15%, or 20%, depending on your total taxable income. Many investors fall into the 15% bracket, and some pay 0% on long-term gains. One important detail is that the IRS uses the FIFO method by default, meaning the first shares you bought are assumed to be the first shares you sold. However, many brokerages allow investors to use specific identification, which lets you choose which shares are sold at the time of the transaction. This can help manage whether gains are short-term or long-term and control the size of the taxable gain, as long as the selection is made before the sale is finalized. Now let's talk about how gains and losses interact. Capital gains and capital losses are netted against each other. That means gains reduce losses and losses reduce gains, but in a specific order. Short-term gains are first netted against short-term losses, and long-term gains are netted against long-term losses. After that, the totals are combined. This system allows losses in one area, like stocks, to offset gains in another, like real estate, while ensuring that losses are not inappropriately used to offset gains that are taxed at different rates. Now let's walk through a simple example. Imagine you have $6,000 of short-term gains and $1,000 of short-term losses. That nets to a $5,000 short-term gain. Now assume you also have $2,000 of long-term gains and $7,000 of long-term losses. That nets to a $5,000 long-term loss. In the final step, the long-term loss offsets the short-term gain, leaving you with zero net capital gain for the year. This is why understanding the netting order is so powerful. Here's the catch. Capital losses are powerful, but the IRS limits how much you can use each year. If your capital losses exceed your capital gains, you can use up to $3,000 of net capital losses each year to offset ordinary income, such as wages or business income. Any remaining losses do not disappear, though. They carry forward to future years with no expiration. This means a bad investment year can still provide tax benefits for many years to come. Here is a more realistic scenario. Imagine a single taxpayer has a $10,000 net capital loss in 2025 and no capital gains that year. In 2025, the taxpayer can use $3,000 of that loss to reduce ordinary income. The remaining $7,000 carries forward to the next year. Now in 2026, suppose the taxpayer realizes $5,000 of capital gains. The carried forward loss first offsets those capital gains, reducing them to zero. After that, the remaining $2,000 of loss can be used to offset ordinary income in 2026. Since this is below the $3,000 annual limit, the entire remaining loss is used, leaving no carry forward going into future years. Okay, let's talk about another important concept: wash sale rule. The IRS prohibits claiming a tax loss on the sale of stock or securities if a substantially identical investment is purchased within 30 days before or after the sale, a 61-day total window. While the definition of substantially identical is not strictly defined by the IRS, this generally includes the same company's stock, options to buy the same stock, or very similar securities. If triggered, the loss is disallowed for the current tax year and added to the cost basis of the new replacement shares. What many investors don't know is that the rule applies to you and your spouse, as well as to shares bought in an IRA or Roth IRA. For example, if you sell 100 shares of Company A on December 1st at a $1,000 loss and then buy 100 shares of Company A again on December 20th, you cannot deduct that $1,000 loss on your taxes for that year. The IRS disallows the loss because you repurchased the same stock within 30 days. To manage this, you can wait more than 30 days before buying back, purchase a similar but not identical investment, or plan sales earlier in the year to avoid accidental wash sales near year end. This is one of the most common mistakes investors make in December. Let's switch gears and take a look at real estate. Homeowners can exclude up to $250,000 for singles and $500,000 for married couples filing jointly of capital gains from the sale of a primary residence. To qualify, you must have owned and used the home as your main residence for at least 2 of the 5 years preceding the sale. Generally, this exclusion can only be used once every 2 years. If the profit is below the limit and you meet the tests, you generally do not need to report the sale on your tax return. If it exceeds the limit, the excess is taxed as a capital gain. Now let's look at 2 scenarios. Suppose you buy a home for $500,000 and sell it 3 years later for $800,000. That $300,000 gain may be mostly or fully excluded from tax if you meet the requirements. But if you sell the same home after only 1 year, you may not qualify for the exclusion, and the entire gain could be taxable. Timing and residency matter just as much as the profit itself. Now that you understand how capital gains and losses work, let's look at the most common mistakes people make. These mistakes are easy to make and often don't show up until tax time, which is why understanding them now can save you real money. One common mistake is confusing capital gains with business income. Capital gains are not subject to self-employment tax, but many investors accidentally report them as business income or mix them into Schedule C, which can result in unnecessary taxes. Another mistake is ignoring holding periods. Selling an asset just a few days too early affects how much tax you pay on a gain. Wash sales are another frequent issue, especially near the end of the year. Selling an investment at a loss and buying it back too quickly can disallow the loss entirely, even though the trade felt harmless at the time. I also see people forget about prior year capital losses. If you have loss carry forwards, they should be used before you pay tax on new gains, but many taxpayers leave this money on the table. And finally, many investors assume their brokerage handles everything. While brokerages report transactions to the IRS, they do not plan your taxes for you. Understanding how these pieces fit together is still your responsibility. Okay, we covered a lot today, so let's wrap this up with a few key takeaways. Capital assets are things you own, not income you earn. Timing determines whether gains are taxed at higher or lower rates. Losses are powerful tools when used correctly. And planning ahead beats reacting after the sale. Understanding capital gains is one of the biggest steps toward keeping more of what you earn. If you found this helpful, subscribe for deeper videos to come on tax loss harvesting, investor tax planning, and more. Thank you for watching.